you'll probably get partial, and after 90 days, it's on yourself. So, and other services such as dental or nursing home cares, those are excluded from Medicare. So, people need to plan for long-term care. Either you need to get a separate long-term care insurance policy or use some of the life insurance policies. Most people should plan ahead with living benefits. Those living benefits has kind of long-term care coverage, even though legally it's not called long-term care, but it's still the living benefits once you qualify for the long-term care terms, right? In the policy, it's like for out of six activities, two of them you cannot take care of yourself, and those will be classified as needing long-term care. Then those living benefits can take effect. So there are two ways to plan for the long-term care coverage. One is a pure or more long-term care oriented insurance policy. Nowadays, a lot of companies offer a combined life insurance and long-term care policy, but emphasize on the long-term care side. Okay, and which might be a more effective way and with some of the let's say final benefits like returning the premium, things like that. Um, or you can plan ahead, use a life insurance with cash value, or even some of those term policies has a living benefits that can cover the long-term care cost. So in general, we'll talk about, besides the Medicare expenses, I'll talk in general, right? What are the investment tools or asset classes we have? Usually, it's for the of the safe ones. It's the liquidity and safety. It's the cash, right? Or CDs are highly liquid and safe investments. So though but it typically offers low investment return. Then we have more of the insurance products, annuities, which can provide a steady income for retirement. Or next, it's tangible assets like real estate, right? So you can have rental income. But those usually real estate lacks liquidity, but it can provide potentially steady income, rental income. So, and then the next is more of the fixed income products like bonds, like cooperative bonds, treasury bills, and also municipal bonds, things like that. So for most people, the basically we have let's say four or five different categories: cash and CD, and the insurance products, real estate investments, fixed income products like bonds, different types of bonds, and then it's more of the growth and aggressive investments assets, the stock, mutual funds of stock, right? So for most people, there's a 100 minus age rule. So what it means is as you age, less investments should be allocated to more aggressive or the growth-oriented investment tools like stock. So if you're 60 years old, supposedly only 100 minus 60, which is 40% of your assets should be allocated to stocks. Okay, then the rest should go to fixed income. Some people have like real estate investments or even partially CD, right? CD, CDs and cash mostly just for emergency funds. Those should not be taken as part of your investment portfolio. So for the risk, for using this rule, it's basically it's balancing risk reward, and also as you age, you psychologically people are more conservative, right? And the investments are becoming lower risk oriented. So as you age, more and more of your assets will be allocated to lower risk investments and adapting to a low risk tolerance as you age. That's what we call the 100 minus age rule. So part of the investment or assets class, one of them is life insurance with cash value. So life insurance policy provides a protection, and it also provides assets growth or cash value growth without suffering the downturns, especially some of the newer products like IUL, Indexed Universal Life, right, which will not give you a negative credit. So the lowest is maybe 0% for the credits, even though there are certain costs, but this serves as a more conservative investment tool and also provides risk transfer and asset protection in case of like death or a critical injury or critical illness, right? Things like that. So nowadays, a lot of life insurance policies provide so-called the living benefits, which means when you are alive and certain situations happen to you, you can use this life insurance to for like the disease care, heart transplants, or cancer curing, right? So this provides protection, and also you can borrow against life insurance policy, and which will create also flexibility. Also, it's a great way to avoid taxes. In life insurance, if you borrow against your cash value, you don't have to pay income taxes or gross taxes for the growth. If you have any other investments like stocks or fixed income or even real estate, when you sell it, you have to pay taxes. And when you get old, you might have even a higher tax rates, right? You have a lot of investment income, and you have to do the required retirement withdrawal. So you even might have a higher income tax after you retire. So using life insurance as a tax-free retirement vehicle is a great way to make your financial assets grow more efficiently. So that's what I talked about for tax efficiency of life insurance. So if it's a not if your life insurance is not an endowed life insurance policy, then once you borrow money or loan money against the insurance, use it as a retirement or any other purposes. You don't have to pay taxes on it. So that becomes making the life insurance becomes a very smart choice for individuals having high tax rates. So that's also great for legacy planning. So the next I'll talk about, what are the new grand trend, right? Everybody knows AI is shaping the society for the next 20, 30 years, right? It's transforming every industry and it drives innovation with automation in healthcare, finance, manufacturing, software programming, and virtually every aspect of your life or every industry. It's making many processes more efficient, right? And increasing productivity. But at the same time, it's going to displace a lot of jobs. And also, it's going to fundamentally change let's say, the distribution or how wealth distributed in the future, and also changing the social welfare structure and system, like social securities and many other welfare programs. I believe eventually many of the unemployed will be, let's say, supported by government welfare programs. Okay. So in the meantime, the rapid changing technology will create market volatilities. Even it might have bubbles right now, right? So like what we have right now. So in the past, just in the past months, I had a few, let's say, news here. For example, OpenAI CEO says AI could replace 40% of the jobs, right? And another example, it's a Ford CEO once said AI could wipe out 50% of the white collar jobs. Not only the white collar, even the blue collar, the manual labor jobs, it could be significantly reduced by AI and robots, right? And just back while ago, a few days ago, Tesla announced in its let's say, blacklight factory, it can produce vehicles 5 seconds per vehicle, right? And without any human being involved. That's another, great example of how technology and automation could displace human jobs. So also because of all the changes brought on by AI and other factors, the housing prices could have great pressure. First of all, because of AI-driven unemployment will increase, and the total or the average income might be reduced. The salaries will be reduced. A lot of people are losing their jobs. High income jobs are being replaced by AI. Also, because of the demographic changes for baby boomers that born after World War II, they are aging or they are passing away, right? Now, based on the average, let's say, life expectancies, people born after the World War II, and that birth rates after World War II is much higher than the average. So more and more people will be aging and will die in the next 10, 20 years. And those old elderly people, they usually they are changing their houses from larger ones to smaller ones and getting to retirements. And also when they pass away, right? So the more the population might be decreasing, so the demand will be lower. Okay, and also another factor is increased housing supply. Like President Trump just announced a policy a couple of days ago, pushing for builders to build more homes. He said there are like more than let's say to you know, 2 million pieces of land that should be building houses upon, right? So urging the home builders to build more houses. And another thing is like more and more modular homes will be built with higher efficiency and lower cost. And all those things will put pressures on housing prices for the next 10, 20, 30 years. So real estate as an investment might not be as good as in the past. We all know that just in the past like 4 or 5 years, house prices has increased significantly due to the COVID-19 and all the central banks in the world printed a lot of money, putting a lot of liquidity in the markets. So for the different assets, right, investment assets, our stock, of course, is providing the highest return for the past 30 years. It returned about 10%, but it also has high risks. Um, so, yeah, let's say, for example, the 2000 bubble, right? The dot-com crash, the stock markets, let's say, decreased more than 55%. And so is the 2008 financial crisis. The markets crashed and decreased more than 55%. Right. So bond provides lower returns, only about 4.1% for the total bond market, but it has much lower risk, right? So cash it's even lower, but it's has high liquidity, right? So for the home prices in the past 37 years, it only increased about 4.3%. So real estate as an investment, it's really not that great, right? So the home prices increased, but even though you have rental income, and nowadays I talk a lot about buying homes in urban, those expensive areas is not really a good investment. So, for example, the house I live in, and it cost about 50 to 100 a month, but the value is about 100, let's say 1,067,000, uh, 100,000, something like that. Okay, so the holding cost, I'll just take like 6% interest, and the holding cost is about 100 grand plus the real estate taxes and insurance and the HOA fees. It's about 130 grand a year. So the owner basically has a $130,000 cost with the home, but he's only renting out for about 60,000 a year. So basically, he's like losing 70 grand a year, okay, which is really not a great investment. So if he used that 1 million, about 1,700,000 dollars somewhere else for investments, he'll make, let's say, conservatively 6%, right? So that's how the holding cost is calculated. So real estate investment, especially in expensive areas like urban, is really not that great. So for the I want to show this chart for the past 70 to 30 years as, for example, for the stock market S&P 500, right? So 2000 it has a crash, and 2008 it crashed again. So after like about 13 years, the stock market provided no return at all. It went back to square one. Okay, so the market only got back to the 2000 level about 2013. Okay, so 13 years without any investment returns. So that illustrates how risk the stock market is, even though average speaking, it generated higher investment returns for people. So the other charts, the chart I'm showing, the reason I want to show this one is to illustrate even much greater stock markets. That's the Japanese Nikkei index. Okay, so it's a 40-year one. So we all know that when we talk about Japan had like a lost 30 years. Basically, the Japanese market peaked on 1989, okay? And it had a high about 38,900. Okay, and it dropped for 20 years. Okay, 20 years, and how much it dropped? 81% down to the lowest points. Okay, and it only back to the peak level in 1989 at the beginning of this year. Okay, so it took about 25 or 24 years for the stock markets to get back. So this one, it really illustrates how risky the stock markets could be, right? So just a week ago or so, Bank of America chief investment strategist warned about the tech bubbles, right? So there are many indications that we might be in a bubble period. The valuations, the price versus the earnings, or the sales versus the earnings are approaching historic highs. Okay, and also the markets are very concentrated in the largest company, a few companies like we call it Magnificent Seven, right? So the Magnificent Seven company accounted for more than 25% of the total market valuation. That's also another indication of past bubble. Uh, so many due to the trends or the significant investments investment risk in stock markets. So we are the people are advising for a more balanced investments the portfolio, right? You should probably allocate more funds to the more conservative investments instead of putting more money in the stock markets. So also one of the reasons I see that is like Goldman Sachs last year forecasted significantly lower returns for the next decades. it's predicting it's about only 3% total investment return, even though this year the stock market performed very well. But many of the fundamentals point to a much lower investment, or we could be in a bubble period that could burst in the next couple of years. So there are many economic challenges ahead. For example, the GDP growth, if you take out the investment spending of the few largest companies, virtually there's no growth, only 0.1% growth in the past quarter. So the strategies or the investment allocations we are let's say promoting or advising is more towards the diversified or conservative portfolio because of the current stock investments environment. So one of the other reasons is also there are many warnings against the debt crisis that's looming right now. All right, the global debt is at a historical high level, and it's very serious risk level, and it's highest against all the for example, the percentage of debts versus the total global GDP, right? So it's increasing the economic instability because of the potentially debt crisis or very high level debts at the moment. So what we can do is to use annuity to reach a certainty. By nowadays, there's a product called annuity with income rider, which will provide guaranteed lifetime income. As long as you live, you will have a guaranteed lifetime payouts from insurance companies. So those protections provide funding for people outliving their savings. So as long as you live, you'll have a guaranteed stream of income. Okay. And also this will make the budgeting much simpler, right? So if you need to consider different investment returns and also the risks involved, the ups and downs of your investments, you even might lose significant portion of your total portfolio. So that make your life plan, let's say retirement planning, much more difficult and much more complex. So using annuities with guaranteed lifetime income make it much simpler and with certainty. So that will address the concerns of not having enough money to live. Also, because nowadays, because of the technology change or development, people will be living longer and longer. For example, just a couple of days ago, there's an announcement that there's a medical advancement that could cure diabetes, right? And just about 2 months ago, for example, there's an announcement that there's a device that could act as a cleaner for the blood vessel, which will basically cure a lot of, let's say, high blood pressure and cardio problems, right? So heart attacks might be avoided, things like that. So anyway, the advancements with AI and medical developments will make people live longer and longer. So using the annuity will solve that problem. So you don't have to be worried about outliving your savings. So for 2024, annuity sales surged to about $434 billion, and it grew about 13% from the previous year because investors had more confidence in the annuity, right? And they probably get to know more and more about how the annuity works and how it could avoid outliving their savings using the annuity. Right. So one of the reasons is also because the interest rates in the past couple of years is much higher than in the past. It's highest in the 18 years history. So higher federal interest generates higher annuity payouts to investors. So that's one of the other reasons that annuity sales in 2024 surged significantly. That's one of the major reasons, I believe, contributed to the growth in annuity sales. This year, we all know that Fed has already decreased the interest rates, three times, right? But still, interest rates is at a very high level. So, buying annuities right now is still a very smart choice for people planning for retirement. But when you are considering retirement annuities, you need to be very careful choosing the right products. Many, in my experience, a lot of agents are not really knowledgeable or completely, let's say, knowledgeable about the insurance products, especially annuities. Some of it has complex features, right? Especially if you purchase an annuity that will generate uncertain payouts. I would advise people to avoid those products, such as Allianz ABC and 222, right? Because it's not like some of the other annuity that has an income right that guarantees your lifetime income. So the illustration, even though shows really good investment returns, but the guaranteed portion is much lower than many of the other annuity products. So you need to consider the risks and that those products will bring, right? Also you need to know the exact terms of those annuity products. So basically, to summarize what I talked about, it's for people planning for the retirement. First of all, it's finding out the gaps, right? What are your expenses? What are for your incomes? You may have to reduce your expenses, right? Or change your spending habits to make sure your savings will meet your retirement needs. And also because of the higher risks involved in stock markets and also like real estate investment because of the trends, because of AI, they will reduce human jobs and resulting in lower income and potentially great pressure for home prices and also pressure for stock market. So annuity will be a safer option for your retirement planning. It also generates guaranteed lifetime income, which you don't have to worry about outliving your savings. So all those reasons cause for you to take action to allocate more funds in your retirement planning to the annuities, especially the Fed will continue to reduce interest rates, which will reduce the annuity payouts for investors. So you should act, as soon as possible to plan for your retirements or for your client retirements using more of the annuities that will bring certainty and bring a lifetime income that will not outlive your savings. That's about it for today's talk, and I'll answer any questions you might have. Thank you very much.
Thank you so much, Jeff. Thank you so much for such a wonderful presentation. So I will ask the audience and see if they have any questions for you, Jeff, and in case they need some information.
Okay.
I'm sure you already share your contact information and your WeChat. In case somebody has questions, just you can contact direct Jeff. He has a bunch of knowledge in this subject on annuities, on real estate, on Medicare. And just remember, he has a master's degree in finance and worked for a 500 company. Is that right, Jeff?
Yeah, I worked for Morgan Stanley, doing the strategic business planning, product planning for the CDMA division. I also worked for another company in charge of the strategic business planning and inventory management for the whole company, which has about 3 billion in sales. Motorola has about 10 billion in sales for the division.
All right.
And I also worked for Morgan Stanley, which everyone knows is a top investment or financial advisory firm.
Sure. So yeah, that's a abundance of knowledge, Jeff. Thank you for such a wonderful presentation. It seems like there is no technical questions about any of your topics.
Okay,
I'm sure people will contact you if they have some questions. With that being said,
sure. Yeah. If you have any questions, you can contact me using my phone number or my WeChat.
That's
Yeah,
right.
thank you very much for your time.
All right. Thank you, everybody. Have a wonderful night, and I'll see you next Thursday.
Yeah, bye bye.